When it comes to insurance, the first thing you have to remember is that it is not an investment. It is an expense. It is the transference of risk of something happening to you to someone else. In the case of life insurance, the insurance company is bearing the risk of loss of life to you and the loss of future income which your family would normally have received over several years. And to take that risk, the insurance company asks you to pay a premium. If the risk of something happening to you is high, the premium is generally costly. If that risk is low, the premium is relatively cheap. Now, there are a lot of insurance policies that combine both insurance as well as investment, but I'm going to be talking to you about term insurance, which is pure life insurance and which a lot of financial planners will tell you is all that you will ever need. There are several questions that arise. First, when do you need a life insurance policy? Well, you would necessarily need to have financial dependence and or you would need to have a significant liability. Now, in the case of the first, your parents may be dependent on you, but they may not necessarily be financial dependents. In that, they could be financially self-sufficient. So there is a distinction. And the second, when it comes to a liability, it could be something like a large home loan, which would have to be paid by your dependents if you were no more. The second question to ask is when you should get life insurance. Very simply put, if you fall into any one of those categories that I mentioned, the earlier you get life insurance, the better it is, because the younger you are, the less premium you would have to pay ordinarily. Third, and perhaps the most important question in this regard, is how much of a cover should you have? Remember that your life insurance cover is a guarantee against a future loss of income. So a simple way to identify the amount of cover that you need is to say that you need to calculate the amount that you would need to give your dependents so that they can get your monthly income in the form of interest on a fixed deposit. So let's take an example. Suppose your annual income is 10 lakh rupees, assuming that the current fixed deposit rate is 6%, your cover would necessarily have to be about 1.7 crore rupees. Now, you may decide that your family does not need your entire monthly income, and so you may reduce it by 30%. And what's more, you may also have a certain amount of investments at this current juncture, say 20 lakh rupees. In that situation, if you were to reduce your annual income to 7 lakh rupees and you were to reduce the 20 lakh rupees from the total cover that you would have, your total cover required would be 1.2 crore rupees. You can choose to do either one of those, it's subjective. The fourth question is how often should you revisit this? And that should be either once every 3 years or in the event of a major change in your life. For example, if you were to get married or if you were to have a child, or in fact, if you were to buy that house and take on that large home loan. Fifth, always remember to disclose exactly what your medical conditions are and your health history, because this comes into play if at all there is a claim to be made. And finally, do remember that term insurance is a cost, it's an expense, and so you don't get any money back. And if you don't get any money back, it's a good thing because, well, you didn't need the insurance to begin with.